Welcome back, everyone. One of the things that investors love to talk about is buying stocks. It's one of the most exciting and fun part of investing, which is doing in-depth analysis on a new company, exploring its fundamentals, deciding that you love a company, you love the products it sells, you love the business model, and then you find it at a good valuation and you want to buy it. That's an exciting part as an investor. And most of the content today is made around buying a company, always focused on the upside, always focused on the growth and the future of the company. But there's another important part of investing that doesn't get enough attention, and that is when to sell. Once we've made a purchase of a company, things can play out in a lot of different ways. Maybe the stock goes up like crazy. Well, do we hold on to it? It seems like it might be a little bit overvalued now. Do we sell the stock or do we hold it? What do we do? Maybe the stock dropped a lot. It had a bad report. That happened to PayPal. A lot of investors are in that stock. It had some problems with the report. The stock is down pretty big, and some investors might be wondering what to do. Do I sell or do I hold on to it? Do I buy more? The complicated questions in investing do not come when you're buying a stock. They come when you sell a stock. That's where things get really difficult, and that's where they get really confusing. In this video, I hope to go over when to sell a stock and give some in-depth thought and structure to this discussion. Now, for this discussion, I'm going to be referencing the work of Phil Fisher with his book, Common Stocks and Uncommon Profits. Phil Fisher is one of the most incredible investing teachers and investors himself to have ever lived, and he was highly influential to Warren Buffett. His investment style was to buy stocks that would go up hundreds and hundreds and hundreds of percentages, long-term, high-quality stocks that were compounders. In fact, he was the original OG compounder investor, and he has a lot of thoughts on when to sell a stock. So we're going to be going into this. Now, one thing I want to just mention on the onset is I've had some experience in this realm as well. I've been investing for quite a bit of time, and I've been in situations that have been very difficult of whether to know whether I should sell a stock or hold on to it or buy more of it. With Amazon and Netflix in particular, Amazon just reported earnings yesterday, and they had blowout earnings. The earnings were incredible. They doubled the EPS that they were expected to and had a lot of good things going in the right direction. The stock is up 10%, and I'm finally back in the green on this company. But the tale of Amazon over the past 2 years has been full of lots of excitement and not in a good way. This company went down 50%. I invested in it, and at one point I was down minus $25,000. $25,000. A lot of money for me. And during that time period, you start to question yourself in your own judgment. Did I make a really bad decision? Should I sell out right now and realize these losses? Should I hold on to it, right? There's lots of things you're going through during that time period. I also had another one have the exact same thing happen, but even worse. Netflix is a company that at one point it dropped 74% from its all-time high. I was in the red by $20,000 in this stock. And similarly, I had to make the decision of whether to sell the stock and move on or whether to hold on to it. And this is where big mistakes can be made. A lot of popular investors were selling out of these two companies at this specific time during the dip. One of them was Bill Ackman, very famous investor, runs a hedge fund. He bought into Netflix. Netflix had a bad report. It went down 30%, and he sold out at a 30% loss. And this was a massive position. He lost $300 million on this bet. Now, Bill Ackman made this mistake on the sale, not on the purchase. Since Bill Ackman bought into the stock is up over any other single stock that Bill Ackman owns. So had he held on to it, it would have been a great success story. But the sell was where the mistake was made. Likewise, with Amazon, Terry Smith held this company when it was trading at a much lower price and then sold out of it before a massive rally. The mistake wasn't made in the buy, it was made in the sell. So buying companies, in my opinion, is very easy. You have a thesis, you've done the research, you're excited about it and motivated. Where the big questions come into place is on the selling. So having said that, let's go ahead and jump into Phil Fisher's advice on this. And again, he is a highly influential person with Warren Buffett. I think he's one of the greatest investment writers, and this book is just awesome. This is chapter 6 of the book that we're going to be going through. What he talks about here are 3 reasons of why to sell a stock. So let's go ahead and go through the introduction. There are many good reasons why an investor might decide to sell a common stock. He may want to build a new home or finance his son in a business. Any number of these similar reasons can, from the standpoint of happy living, make selling common stocks sensible. This type of selling, however, is personal rather than financial in its motive. As such, it is well beyond the scope of this book. These comments are only designed to cover the type of selling that is motivated by a single objective: obtaining the greatest total dollar benefit from the investment of dollars available. So he outlines here that if the question is, should I sell stocks because I want to pay for my college or I want to do a down payment on this new home, this has nothing to do with that. Those are life decisions, and that's completely outside of the scope of what we're doing here. What he's talking about is maximizing your dollar. Every one of us only has a certain amount of capital to put at work, and we want to maximize the returns of that capital. And this is his instructions on how to do that. He says, I believe there are 3 reasons, and 3 reasons only, for the sale of a common stock which has been originally selected according to the investment principles already discussed. Now, this is chapter 6. In chapter 3 of this book, he goes through 15 different points of why you should buy a stock. And it's very similar to the type of stuff that I outline. You want to buy companies that have incredible business models. They're capital light and efficient. They have good pricing power. They have very sensible, stable management. They have very predictable and long runways of growth, and so on and so forth. We've gone over the buy thesis of stocks many times. So he's saying that there's only 3 reasons to sell a stock that has been bought with these type of principles. The first of these reasons should be obvious to anyone. This is when a mistake has been made in the original purchase, and it becomes increasingly clear that the factual background of the particular company is, by a significant margin, less favorable than originally believed. If the company looks less favorable than you originally believed, and you realize there were mistakes made in the analysis. Now, I can relate to this. I'm not perfect when it comes to investing. I make mistakes from time to time. And one company that it became increasingly clear that I had made a mistake in my investment analysis, I believe, was with Disney. I viewed Disney as a very high quality company when I first bought into it. I viewed it as this great company that had great assets. They had Pixar, Lucasfilm, Marvel, Disney Studio Animation. They had a new Disney Plus service where they're going to throw all of the stuff on it and gain a ton of subscribers. That was the analysis I did, that there was so much upside for the company. But I had a big oversight. I didn't do proper analysis into the decaying parts of their business. Disney has legacy cable with ESPN, where they're losing millions of subscribers a month. And that part of the business that's going down over time is basically canceling out the growth part of their business. It's just moving customers from one portion of the business to another. Once I realized that there were big mistakes in my original analysis, that Disney had parts of the business that were not moving in the right direction, and that they were a much more complex, difficult to operate business than originally thought, I decided to sell out of the company. And I admitted that mistake. I had made a mistake in my judgment and analysis on the company. Now, he says, the proper handling of this type of situation is largely a matter of emotional self-control. To some degree, it also depends upon the investor's ability to be honest with himself. You have to be honest if you just made a mistake. Again, everyone does this from time to time. You buy into a company after doing some analysis, but then you do a little bit further analysis and it reveals some things you do not like about the company. And rather than being dishonest with yourself and being prideful and doubling down on the mistake, it's important to have some introspection, to be humble enough to realize you made a mistake, to sell out of the company and move on to a better bet. 2 of the important characteristics of common stock investments are the large profits that can come with proper handling and the high degree of skill, knowledge, and judgment required for such proper handling. Notice he doesn't say buying. It's not just the skill of doing analysis and buying, it's of handling the shares once you own them. Since the process of obtaining these almost fantastic profits is so complex, it is not surprising that a certain percentage of error in purchasing are sure to occur. Fortunately, the long-range profits from really good common stocks should more than balance out the losses of normal percentages of such mistakes. They should leave tremendous margin of gain as well. So if you have a couple stocks that do really poorly that were mistakes, the ones that are winners should more than make up for it. They should overall average out to what he describes as a tremendous margin of gain. This is particularly true if the mistake is recognized quickly. When this happens, losses, if any, should be far smaller than if the stock bought in error had been held for a long period of time. Even more important, the funds tied up in the undesirable situation are free to be used for something else, which, if properly selected, should produce substantial gains. So what he's saying here is, if we've made a mistake in our analysis and it becomes apparent, move on quickly. Don't go over it and debate it and hold on to the stock for a year hoping it will go back. That is a huge mistake. Once you realize there was a substantial mistake in your investment and the company no longer possesses those traits, it's time to move on. He says, however, there is a complicating factor that makes the handling of investment mistakes more difficult. This is the ego in each of us. None of us like to admit to himself that he has been wrong. If we have made a mistake in buying a stock, but can sell the stock at a small profit, we have somehow lost any sense of having been foolish. Now, this one hits home. I have made foolish investments in the past that I've made a profit on. And it's easy to convince myself that it wasn't a foolish investment because I made a profit on it. One of the companies was Peloton. I made 100% gains on Peloton. I bought the stock, $1,000 of it. It went to around $1,900, so it was around 90 to 100% gains. And I sold out once I saw momentum going away from the stock. As soon as I saw a little bit of weakness in demand, I sold out of it. Now, I can try to brag about how I got 100% gains on that stock, but that's not the truth. The truth is, I should have never bought that company to begin with. It was an ill-advised investment from the beginning. Peloton was never this long-term compounding machine. It was never an amazing stock from the beginning. It faced immense risks, immense challenges, and the future was incredibly unpredictable. I got lucky in that stock to have bought it at a time where there wasn't a ton of momentum. Momentum took it way to the sky, and then I sold out at a favorable time. And that's not the only stock I've done that with. There's some other lucky bets that I've made. But what he's saying here is, it's easy to convince yourself, if you've made money at all in a stock, that it wasn't a mistake. You weren't being foolish. And you should be honest with yourself. Investing in Peloton was foolish, even though I made money in the company. And there's likely companies that you've done the same in. So try to identify whether or not your gains are from good judgment and sticking to your thesis, or if you got out a little bit lucky from the stock and it was a foolish investment from the start. Now he says, on the other hand, if we sell at a small loss, we are quite unhappy about the whole matter. This reaction, while completely natural and normal, is probably one of the most dangerous in which we can indulge ourselves in the entire investment process. More money has probably been lost by investors holding a stock they really did not want until they could, quote, at least come out even, than from any other single investment reason. People lose money in common stocks all the time for trying to break even. They're down a little bit in it, and they do not want to hit the sell button because that means they lose. That means that you are dumb, you made a bad investment, you're not a good investor if you sell at a loss. Even though that's the right decision to do. Even though you know deep down you don't want to own this company anymore. But you just can't fathom the hit to the ego to sell at a loss. None of us like to admit that we were wrong, and this ego comes into play. If we've made a mistake in our investment thesis and the stock goes down, lots of investors sit there wanting it to go back in the green because if it goes in the green, you're not a dummy. When in reality, the only reason you're holding the stock is because it's in the red. When in reality, what he outlines here is that as soon as you realize you have made a mistake in your original analysis of the company's fundamentals, you should sell the stock, and that does not mean that you had not been foolish if you had a gain, and it doesn't mean that you're any more foolish if you had a loss. Either way, you misjudged the company. That's the mistake. And it's a bigger mistake to hold on to it now after realizing that you misjudged it. He says, if to these actual losses are added to the profits that might have been made through the proper reinvestment of these funds, if such reinvestment had been made when the mistake was first realized, the cost of self-indulgence becomes truly tremendous. Now, this is kind of a wordy way of saying this sentence, but what he's saying is, if you hold on to a stock because you want to get back to break even, because you can't fathom selling at a loss, then you're really losing more money because you could instead take that money out and put it in a better situation, a better company, where the analysis wasn't incorrect from the start. So this is all doing with pride, with ego. We have to be willing to admit to ourselves when we were wrong about the original analysis of a stock and move on quickly when we first realize the mistake. Don't hold on to a bad stock. Furthermore, this dislike of taking a loss, even a small loss, is just as illogical as it is natural. If the real objective of common stock investment is to make a gain of a great many hundreds of percentages over a period of years, the difference of, let's say, a 20% loss or a 5% profit becomes comparatively insignificant matter. So who cares? If you realize you've made a mistake and the stock's down a little bit, but you can move on and move it to a different company, who cares if it's down 20%? Who cares if it's up 5%? The goal of these stocks that he invests in, these compounders, is to make hundreds of percentages of gains. That's where investors make the big money, by compounding huge amounts of wealth over long periods of time. It's not by waiting for a stock to go from 20% in the red to 5% in the green. That's not going to move the needle. While losses should never cause strong self-disgust or emotional upset, neither should they be passed over lightly. They should always be reviewed with care so that the lesson is learned from each of them. If the particular element which caused misjudgment on a common stock purchase are thoroughly understood, it is unlikely that another purchase will be made through misjudgment of the same investment factors. Now we finally move on to number 2. Just to review number 1, the number 1 reason we should sell a stock is if we come to realize that one of our investment theses, the research we did on the stock, was misjudged, that we didn't get the full picture of the company, and we've realized that there was an error in our judgment of the company. We should sell the stock as soon as we realize that error. We should not try to wait. In fact, it's empirical that we don't try to wait for the stock to go back in the green. That's that little mental thing we have where we have to try to make a gain on the stock. It has to go back in the green, and that leads to greater opportunity cost, and it leads to greater destruction of value than if we just moved on and invested in something else. Now we move on to number 2. We come now to the second reason why sales should be made of a common stock purchase under the investment principles already outlined in chapters 2 and 3. Sales should always be made of the stock of a company which, because of changes resulting from the passage of time, no longer qualifies in regard to the 15 points outlined in chapter 3 to about the same degree it qualified at the time of purchase. He says this is why investors should be constantly on their guard. It explains why it is such importance to keep at all times in close contacts with the affairs of a company whose shares are held. When I look at Qualtrim, I'm keeping track of the fundamentals of every company, making sure they're going in the direction that I want them to. If things start going in the wrong direction, and I realize the company no longer meets the criteria in which I invest, it's time to move on. When companies deteriorate in this way, they usually do so for one of 2 reasons. Either there has been deterioration of management, or the company no longer has the prospect of increasing the markets for its products in a way it formerly did. Sometimes management deteriorates because success has affected one or more likely key executives. Smugness, complacency, or inertia replace the former drive of ingenuity. More often it occurs because of a new set of top executives that do not measure up to the standard of performance set by their predecessors. Either they no longer hold to the policies that have made the company outstandingly successful, or they do not have the ability to continue to carry out such policies. When any of these things happen, the affected stock should be sold once. So for no other excuses, there's nothing that should stop you from selling a stock if it has new management that are not up to the task of running it. If you get poor management, they will destroy investor value, and you'll lose a lot more money to holding the stock than you will to capital gains tax. Similarly, it sometimes happens that after growing spectacularly for many years, a company will reach a stage where the growth prospects of the market are exhausted. From this time on, it will only do about as well as the industry as a whole. It will only progress about the same rate as the national economy does. This change may not be due to an deterioration of management. Many managements show great skill in developing and related and applied products to take advantage of the growth in their immediate field. They recognize, however, that they do not have any particular advantage if they go into an unrelated sphere. The reason that we invest in individual companies is to have excess gains, to outperform the market. So if we believe that no longer can this stock grow in a way that will outperform the general market, we may as well sell it and look for a better opportunity. Because if you're going to have market performance, you may as well just buy the market, just buy an ETF. The goal here is to outperform the market And you can't do that with companies that have completely exhausted their growth paths. So reason one is because we've made a mistake in our original analysis. Reason two is because the stock has grown so mature and so big that it's just going to grow right along with the economy. And that's a point where we can sell at a bit slower of a pace, move into something else. Now we get to reason three. For those who follow the right principles in making their original purchases, the third reason why a stock might be sold seldom arises. So this is a rare case. And what he goes on to outline here is basically the third reason we should sell a stock is if we find a much more attractive situation in a different stock. So basically we buy into these companies, we buy good companies and they remain good companies, but we might run into a better company at a better price. If the evidence is clear cut and the investor feels quite sure of his ground, it will, even after paying capital gains tax, probably pay him handsomely to switch into the situation with seemingly better prospects. So this is high grading your portfolio, moving from one company that you think is good to another company that you think is even better and has even better prospects. A word of caution may not be amiss. However, in regard to too readily selling a common stock in the hope of switching these funds into still a better one, there is always the risk that some major element in the picture has been misjudged. If this happens, the investment probably will not turn out to be nearly as well as anticipated. In contrast, an alert investor who has held a good stock for some time usually gets to know its less desirable as well as more desirable characteristics. So basically he's saying, the longer you hold a stock, the more you get to know the company, both good and bad. So you have a better idea of what the company is. And if you just find a new shiny company, you want to be very hesitant to sell something you know and understand for something that just sounds a little bit better. So this is why he says to do this rarely. If you have a very good situation in a stock, be very reluctant to upgrade it to another one. So you can upgrade your portfolio, but do it with a great deal of care. Now, this last reason that he outlines, I think is by far the most important out of any of these, and that is a question of valuation. I get asked more than anything of whether or not this stock is overvalued and should I sell it. Joseph, this stock is up to a 32 PE ratio. It's overvalued. Everyone's saying it's overvalued. Should I sell it? Here's Phil Fisher's thoughts on selling because of valuation. This brings us to another line of reasoning so often used to cause well-intentioned but unsophisticated investors to miss huge future profits. This is the argument that an outstanding stock has become overpriced and therefore should be sold. He's calling people that do this unsophisticated. What is more logical than this? If a stock is overpriced, why not sell it rather than keep it? Now here's the problem with trying to make these sophisticated judgments of whether or not a stock is overpriced because it's at a 35 PE ratio instead of a 25. All of this is trying to measure something with a great deal of precision than is possible. The investor cannot pinpoint just how much per share a particular company will earn 2 years from now. He can at best judge this within such a general non-mathematical limit as about the same or moderately up or up a lot or up tremendously. That's about all analysts do. Well, I think earnings are going to go up a lot for this company. I think earnings with Chipotle over the next 5 years are going to be up tremendously. That's about the level of precision we can do. Now, you can fool yourself, and I've seen lots of people fool themselves into believing they can have precise measurements because they put it on a spreadsheet with a DCF. That's guessing. You're just doing it in a more formal way. But really, all you're doing is guessing, even with a DCF. He says, as a matter of fact, the company's top management cannot come a great deal closer than this. Either they or the investors should come pretty close in judging whether the sizable increase in average earnings is likely to occur a few years from now, but just how much increase, or the exact year in which it will occur, usually involves guessing on enough variables to make precise predictions impossible. Under these circumstances, how can anyone say with even moderate precision just what is overpriced for an outstanding company with an unusually rapid growth rate? Suppose that instead of selling at 25 times earnings, as usually happens, the stock is now at 35 times earnings. Perhaps there are now new products in the immediate future, the real economic importance of which the financial community has not yet grasped. Perhaps there are not such any products. If the growth rate is so good that in another 10 years the company might well have quadrupled, is it really of such a great concern whether at the moment the stock might or might not be 35% overpriced? That is such a valid point, and one that I try to make continually. He says that which really matters is to not disturb a position that is going to be worth a great deal more later. So when I look at companies and I'm doing analysis on them, I run DCFs on every position that I buy. I ran one on Chipotle, a new company I'm buying, and it came in that it was 20% overvalued. I'd like to get Chipotle 20% cheaper than it is today, but I bought it anyways because I agree with Phil Fisher here. Is it really that big of a deal if a stock is 35% overpriced, if it's a huge compounding winner over the next decade that will quadruple in value? It really doesn't. And this is the type of thing that keeps investors out of very, very attractive companies, ones that are going to become much bigger, multiples bigger in size. He outlines a few things here. The people that say to sell a great quality company because it's overvalued, they have no specific precision way of measuring the valuation of a company. They can't possibly, with accuracy, guess the next 2 years of earnings of a company. So they really don't know if the company is overvalued to begin with. And even if the company is overvalued to some degree, if it's really a great company, that won't matter in enough time. If you bought Apple overvalued any time in the past 10 years, you still made more money than the market. Now he moves on to the next argument that many investors make on valuation. There's still one other argument investors sometimes use to separate themselves from the profits they would otherwise make. This is one that is the most ridiculous of all. It is that a stock they own has had a huge advance, therefore just because it has gone up, it has probably used up most of its potential. Consequently, they should sell it and buy something that hasn't gone up yet. Outstanding companies, the only type which I believe the investors should buy, just don't function this way. The type that he outlines is what I call compounders, and those companies go up a lot. And if you try to sell them because they went up a lot, you're likely going to sell a great company that's going to continue going up. That's the whole purpose of these type of companies that he buys. And these type of companies are even more prominent in the market now than I believe they were during his time. So Phil Fisher believes that there's 3 main reasons to sell a stock. The first is because you made a mistake. And that is something all of us do from time to time. Sell it as soon as you made the mistake. Drop the ego, drop the pride. It's okay to lose money on a mistake that you invested in. And in fact, it's way more advantageous for you as an investor to sell right away. The second reason we should sell a stock is because we may have not made a mistake, but things just did not evolve well with the company. Maybe they got new management. Maybe there was a new competitor that came in and really threatened them and took a lot of market share. If the investment no longer fits into your overall thesis and the constraints that you make for your investments, sell it and move on. And then the third reason that he outlines is that we should sell a stock because the growth prospects are no longer there. It's matured, it's massive, but it's going to be growing right along with the S&P 500. If a stock is going to have S&P 500-like returns, we should just buy the S&P 500. What he says is the reason you should not sell a stock is because of slight overvaluation. A company went from a 25 forward PE to a 35. If that company is outstanding, then that's not a reason to sell it because it's likely to be multiples bigger in the future. And the 20 or 30% overvalued only matters within the next 6 months, the next year. So we should hold on to good quality stocks and not be so value sensitive, especially as he notes, people have no clue about the precision valuation of a company. We're all just making guesses. And then finally, he closes off with this part on this chapter. Perhaps the thoughts behind this chapter might be put into a single sentence. If the job has been correctly done, when a common stock is purchased, the time to sell it is almost never. So that's his job. His job as an investor and our job, if we're following this type of investing, is to try to buy companies that will literally never want to sell. That's the caliber of companies we're looking for. And that's how I have a lot of my investment philosophy around. So let me know if you like this type of content, diving into these type of concepts and digging in a little bit deeper. And I may do more of this in the future. But that's all for now. Hope you enjoyed. See you in the next one.